What's going on, guys? I wanted to make a new video for you all. Kind of drew up all of this yesterday, and I wanted to make a whole video explaining all this, kind of like a general rule, things to look out for, things to remember, to abide by. So yeah, I drew all this out. We're gonna go through one by one, make sure it all makes sense to you guys. But yeah, I feel like pay attention. I feel like this video is going to be very powerful to some of you, especially. All right. So first thing, of course, we know trading with structure is low probability. Avoid it. Okay. Why do I say that? Okay. Sometimes structure works. The reason this is, if it never worked, retail would never use it, right? If this pattern of never worked, why would retail use it, right? So that's why it has to work sometimes. The reason it works sometimes is retail sees that it works, so they're going to keep using it, right? They fail to realize, though, why it works. And it works because it builds liquidity for us. So that's why we automatically have an edge over them, because we let the liquidity build, we let this occur, then we understand that now there's liquidity above here and we can target this. Okay, so as we all know, invalid short. We don't take these kind of trades. If you wanted to short this, you need to short it from above this high. Simple stuff. Okay, next. This is going to be another similar scenario, but with a little twist to it. So as we can see, price reacts off this smart money trap to the left-hand side over here. Okay, so some sort of low to the left. We move bullish, run some sort of liquidity to the left. Okay, creating a liquidity block. Then we short, we move lower, we print a high, low, high. Why is this important? This induces retail. Okay, traders that trade with these patterns, this break of structure patterns, they're going to be entering trades here. Okay, now we understand that they enter shorts here. They are going to be having their stop losses above this high. So coincidence, we sell off to the downside, react off to this smart money trap once more. Okay, pushes us long, trapping short sellers in this area, and not only that area, this high here. And that is where we're now going to take our sell entry from. The reason why it respects this area is because right above it we have liquidity block. Okay, so shorts are taken right here and we ride this back down. Why are we targeting this low? We are targeting this low because look, we react off it once and we react off it twice. So we now understand that buyers are entering positions in this red box, this area. So we are going to target the low now. Okay, simple stuff. Okay, now it's going to get a little more complex. Next thing I want you guys to always keep in mind is identify your liquidity and wait for it to get taken. Stay numb and don't be induced. What do I mean by that? These examples, right 1 and 2 are the two examples of taking trades when they're invalid. All right, so first scenario right here. We see price go long, print a high, low, high. So now retail sees this as BOS to the upside. Okay, retracement down into their demand, into their POI. Price goes long. Okay, now we understand liquidity is below this low. Look what price does though. Okay, and I see a lot of you guys make this mistake. We get a sell off down, and now you guys think this is a BOS in the market. So immediately you guys want to go long. You have to remember that we're not pattern traders, guys. You have to be able to identify the liquidity. Okay, just because we've taken out this low doesn't mean we're just going to rock it up to the upside. Okay, the liquidity is down here and we need to be waiting for this low to go. Okay, that is when it'll be valid. Okay, look at the difference here. Price goes long, pull back into their POI, we go long once more, and then we get a retracement down, and look at this. We clear the liquidity. Now this is a valid buy. Okay, so no good, this is good. Perfect. Now on to the next example. Price goes long, high, low, taking out previous lows, printing us a liquidity block. And then we have another high printed, a low, and we go long, taking out the previous structural point. Okay, why is this important? Retail interested in buying here. And look, we have to allow the market to build liquidity. And look what we do. We go short, we react off this area, and we go long. Okay, again, taking up previous structural point. Now we know where liquidity is. Boom. Okay, we short, and wow, look at the market does. We take out the low. Here's a BOS. Again, this is where some of you guys want to go long, but it's incorrect. The liquidity is not taken yet. It gives a reaction up, okay? And sometimes it'll even take out the high once more. But if it does, if it takes out the high like this, from low to high, this is not a move we want to be involved in, okay? Because now you're trading not with the system, okay? You're just assuming, you're just predicting that price is going to go up instead of waiting for that liquidity to get taken. Okay, so again, this is not an entry we take. If you look to the right-hand side, liquidity block printed, same thing occurs, but we actually run the liquidity this time. So this is going to be valid. All right, so that's what I mean by stay numb and don't be induced. Okay, because look how early traders are going to be getting induced here and in here. Okay, the patient traders will be taking longs from here and from here. Okay, so keep this in mind. Okay, now on to the last rule for this video, and it's going to be understanding logic over pattern trading. Okay, liquidity always, and that's very, very important. A lot of you guys I see in the group, I don't want to say a lot of you, but some of you always see, for example, let's say we're going short and we have a BOS to the downside here. As soon as this low is taken out, immediately you guys are like, okay, I will not short until this high is taken, okay? Any sort of reactions, whatever occurs, I will never be shorting until this high is taken out. And that's just simply called pattern trading, okay? Rather than involving logic into your analysis, meaning liquidity, okay? So, no worries if you guys are a little bit confused. That's why I have a bunch of examples to go through right now with you, okay? So first ones I'm going to go through are these two, all right? First one being the valid one, all right? So, step by step, we have a low printed, high, low, okay? Building liquidity here. And then we go long once more, taking out the structural point. Why is this important? Retail is going to see this as an area to long from now. Okay, that's why I have the red box. So this is going to be a trap. All right, then we go short. Then we go long. This is the important part. Okay, keep in mind, we take liquidity from the left-hand side. Some sort of high over here. We took that high. All right, then we get a reaction down. Push up. High, low, high, sell off. Why is this important again? Retail sees this as BOS. So they're going to be entering positions right here. Okay. And then the market sells off aggressively. Perfect. Now we know there's liquidity above this high. Okay. Something I want you guys to keep in mind now is a lot of you guys will be like, hey, Marco, but we had a BOS here, so I can't short here. Why? That's ridiculous. Look at the bigger picture here. We understand that this is going to be a trap. We have liquidity to the downside. Liquidity is now taken from the left to the upside. We have no reason but to short. Okay? All the confluences are leaning on shorts. Okay? This doesn't mean we can't short from here. That's ridiculous. Okay? Look at the bigger picture again. BOS here. This is going to be false reaction if there's reactions. Okay? And look how the market builds liquidity for us here. Then we go long. Take out the early sellers. Mitigation of the liquidity block. Anywhere above this high right here, anywhere above this high is a valid sell. Okay? Now, I've shown you guys the valid one. I want you guys to see where you guys make mistakes now. Okay? Look, same scenario. We go long here, taking out previous structural point. Okay? Now understand this is going to be a trap down here. The market gives a reaction down. We short, and then we go long, taking out previous high again. All right? But look what we're doing. We're still trading within this SMT, this smart money trap from the left-hand side. Okay, so some sort of high over here. All right, we've reacted off it once over here, and now we've reacted off it again. And then we sold off. What does this now tell me? This tells me now that we still have liquidity to the upside. Okay, look at the difference. Liquidity taken from the left. False reactions to the downside. Okay, now you can flip this perspective. This is where you bring in the logic over this pattern trading. Some of you guys have this perspective on. Look what happens here. We short. Okay. Yes, we've left internal here. We've left early sellers here, which is fine. Then we respect the SMT, this smart money trap to the downside. This is not a long we want to take right here. This low, not a long we want to take. The only time we'll take this let's say there was a um, let's say there was a liquidity block of some sort, okay, and this low was printed after running liquidity. Yes, you could take this, no problem. But in my example here, this is just trading with structure essentially. So this is gonna be a no-go, okay? No trade here. And then this low here, no trade. This low here, no trade, because you're just trading with structure, okay? So we avoid these kind of entries. Look what price does here. We go long. Reaction. Again, this is where some of you guys sell from. And you guys are trying to tell me, look at all the liquidity to the downside. Guys, the liquidity is not taken to the upside yet. So why are we going to short? Remember, we have to induce higher. We have to induce higher in order to go lower. Okay? And that's what happens here. This is where a lot of you guys are entering your shorts, but you're early. Okay? And then you get a reaction down, and then boom, you get taken out. Okay? Then the short occurs. All right? So this one I know is probably going to hit home with a lot of you guys. So keep this one in mind. All right. Next example. Just because a BOS to downside occurs doesn't mean we can't sell at all. What do I mean by that? Okay. Take a look at this. We have low, high, taking out previous high. Okay. So same thing. Then we go short, high, and again, we take that liquidity from the left-hand side. Why is this important? This now allows us to go short. Okay, but now we have to wait for some sort of short setup to occur. Okay, after running the liquidity from the left-hand side, we go short. We have this BOS here. Again, this is where you guys, this pattern perspective you guys have kind of psychs you out. Now immediately you guys are saying, okay, we've taken out some sort of low. Now I can't sell at all. No, that's not the case. Okay, where is the liquidity? We short, we print this high, and then we short again. This is going to be trap. Okay, retail is going to be buying here. Any reactions are just going to be building liquidity for us. And that's what happens. Okay, we go long, high, low, high, false sell-off. Why? Retail sees this as BOS. So they're going to be shorting here. It gives us a false sell-off. This is what we want to see. This false sell-off from high to low. Why do we want to see it? It creates a liquidity block for us. And now if we have some sort of liquidity built above it, we can use this as a buy. And that's exactly what happens. Look, we have high, low, respecting previous low. And we go long once more. Respect the trap, false sell-off, boom, buy entry. Okay, where do we target? Simple stuff. Where is the liquidity? Boom, right there. You don't want to be holding after this high is taken out. Okay, because now the liquidity is taken. This buy setup is done. Okay, and look what happens after we take out the high. High printed, sell off. Okay, mitigating that liquidity block. Anywhere above this high essentially was a sell. Okay, now look at the flip side. This is where some of you guys make mistakes. Again, we're reacting off something from the left-hand side once, twice, sell off down. Okay, push up, high, low. Same thing as this example up here. We have high printed, low printed, high, false sell-off creating liquidity block. Then we have the build-up, boom, false move down, taking out the build-up. This is a valid buy down here. Okay, beautiful buy down here. And partialing here. Not only that, we understand that this reacted off to something to the left-hand side, giving us a false reaction. This is going to be your target now. That is where the liquidity is. But unfortunately, some of you guys are selling right here, not understanding where the liquidity is and kind of looking at price as a pattern. We do not trade price as patterns. We're always looking and finding liquidity. Okay? So, I hope you guys enjoyed this video. Feel free to watch as many times as you need. I'll also have it uploaded as like a PDF so you guys can look at just the picture if you want, take some notes, study it. But yeah, that's it for me. I hope you guys enjoyed, and I'll see you soon.